Welcome to VTS and the first video in a new series that you will definitely want to follow along with. I'm going to be introducing each individual volatility metric from my volatility dashboard. Now, the up-to-date values are shown in every daily email to VTS subscribers. So if you want to start profiting from these signals, of course, there is a free trial to VTS available to everybody. But at the very least, make sure you give the video a like for me because I'm going to be showing you some information that you won't see anywhere else. In this introduction video today, I'm going to prove to you why you need to learn about my volatility metrics. Today, I'm going to put my money where my mouth is and show you with real numbers, not just words, why it actually works in the real world. Over the coming months in this series, we'll cover all of these in more detail, but that one there called the VX30 to VIX Roll Yield, let's use that metric to actually start making some money. So the VX30 to VIX Roll Yield is a representation of how much these front 2-month VIX futures are above the VIX index. This is important because remember, the volatility ETFs like VXX, UVXY, SVXY, there's many of these, they derive their value entirely based on the price of those front 2-month VIX futures. But another thing we know is that on expiration day, that front month VIX future will be equal to the VIX index value. This happens every month. Just for that one day on expiration, they will be the same value. So it makes sense that if these front 2-month VIX futures are trading above the VIX index, then over time they have a higher probability of decaying down to match the VIX index at expiration. This situation would be a tailwind for the short volatility trade. So I have a metric that I call the VX30 to VIX Roll Yield that measures how far above the VIX index those VIX futures are trading. Now here's where it gets interesting, and this is why I say that these volatility metrics actually work in the real world. This isn't just talking on Twitter. What if we were to say that if my VX30 to VIX Roll Yield metric is above its 50th percentile value, then we would be short volatility. And if it's below its 50th percentile value, we would move to cash. Just a very basic if this then that threshold. This isn't cherry picked in any way, shape, or form. It is quite literally just a dirt simple 50th percentile value. So now we need a benchmark, right? This is the S&P 500, the SPY ETF, which includes all dividends back to March 26, 2004. The reason we use that date is that was the actual launch of the VIX futures. So that's as far back as we can drag this example. But you can see the performance here, 9.73% annual return with a maximum drawdown of 55.19%. Now, I will say that's a very low return given how big the expected drawdowns are. I know there's a lot of people out there that recommend buy and hold, but that is a terrible strategy. I wouldn't wish that on my worst enemy. Almost nobody has the risk tolerance to sustain a 50% drawdown and then just continue investing. This is why our VTS community focuses on tactical investing with volatility targeting. But this is the baseline S&P 500 that I said we can easily beat with a good understanding of my volatility metrics. So let's apply that very simple test using the VX30 to VIX Roll Yield. Above or below a 50% line, that's it. Here we are inside a basic spreadsheet, and this is the S&P 500 buy and hold. This includes all dividends, and it goes back to March 26, 2004. And this over here, we can see our very simple volatility filter. We've got the VX30 to VIX Roll Yield, and this also goes back to the same date, March 26, 2004. And then we've got our underlying instrument. This is the SVXY. So to apply the filter, you can see it here. If I just highlight this formula, it is, like I said, just a dirt simple if this then that. You can see it here. If this VX30 to VIX Roll Yield number is above this 50th percentile value, then we would be short volatility. If it's not, then we would be in cash. Now, if you want to see where this 50th percentile comes from, this here is showing the VX30 to VIX Roll Yield going all the way back to inception. As we can see, it's actually positive about 82.63% of trading days. But there's that median value. That is the 50th percentile line. It's above 8.41% half the time, and it's below it the other half. That's why we get this as our 50th percentile threshold. So if we want to see the results, here it is. We can blow this thing up a little bigger so you can see it. And with just the most rudimentary filter, we've already substantially improved performance. Now, obviously in my own portfolio, I go many steps further than this. I don't handcuff myself to a single metric and a single threshold. For me, my volatility strategies have a much higher return with even lower drawdowns. But again, today's test is just a proof of concept. Holding the SVXY just 50% of the time, filtered with the VX30 to VIX Roll Yield, now the annual return is 17.15%, with a maximum drawdown of 39.27%, and the risk-adjusted return using the Sharpe ratio is now 0.81. As we can see, it's a dramatic improvement across the board with just one single volatility filter. Rate of return way higher, drawdown much lower, risk-adjusted return over twice as good. Now remember, with respect to my VTS portfolio, I've always posted the live results on my website every month. I launched VTS in January 2012, so that's over 12 years ago, and I don't hide anything. I show the good, the bad, and the ugly. The point is, in my opinion, there is no better way to consistently beat the stock market than to have a really good understanding of the volatility complex. Using my volatility metrics in a systematic, rules-based manner is the best way to get an awesome long-term rate of return. This new series is going to break down all the metrics, what they mean, how to use them, and we're going to start with the easiest ones and then work our way towards complexity. You have two choices for the next video to watch. If you click this one, you will continue down the rabbit hole of this volatility metrics series. If you watch this video, it will explain how my flagship volatility ETF strategy has tripled the performance of the S&P 500. Choose your own adventure. I'll see you in the next lesson.